Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is March 29, 2023. I'm going to cover my market insights on both equities and bonds and precious metals. We'll begin with the dashboards. The first one are the major indexes. Let's see, we've got 5 U.S. indexes, 2 foreign indexes, and the long-term government bond index. So I put in the center of the dashboard, I put a yellow box and a pink box. And this covers, the yellow box is the last week, and the pink box is year to date. And then to the right of that, we have the dots, and these are, where do these averages, these are indexes, or the indexes, not averages, where are they relative to their 20, 50, 100, and 200-day moving averages? And if they are above that moving average, it is a green dot. If it is below those moving averages, it is a red dot. So you can see it's a mixed bag. Generally, this last week was positive, more positive than negative. But there are parts that are negative, so we'll cover both. When you look at this, starting from this is sorted from, on the pink box, from the strongest, the highest gain, to the weakest at the bottom, based on where they are in the pink box. So at the very top, the NASDAQ 100, the long-term government bond index, and so forth, and foreign markets and S&P. I put a white line underneath the S&P. It's sort of in the middle, but it tells you where it is and those that are above it and those that are below it. The weaker ones are emerging markets, small cap index, Russell 2000, and the weakest is the Dow Industrials. These are almost exactly the opposite from where they were last year. So the ones on the bottom were on top, and the ones on the top were on the bottom. But you can see from the yellow box, on the weekly, they all had gains except for the bonds, which was no change. So we'll see some of this later. When we go to the S&P 500 and break that down to the component parts of the S&P 500, the sectors within the S&P, we see a more detailed story. So I still have the weekly view, which is in the yellow box, and the year-to-date view, which is in the pink box, and then where they are relative to their moving averages. So you see that the strongest is on top, which is technology and growth stocks and consumer discretionary, and then you go all the way down to the bottom and you find more of the old economy stocks, the healthcare, financials, and energy, and going from more green to more red. In the pink box, the year-to-date numbers, the technology is by far the best. Again, remember last year, it was by far the worst, but it's changed places. And then consumer discretionary, some nice gains in that as well. And after that, everything else is negative, going all the way down to energy, which is 10.95% negative for the year. I remember seeing, I think it was around September or so last year, it was about 6 months ago, energy was up last year 64%. I remember seeing that number one of the weeks I reported it. It was screaming, and everything else was negative. It was the only thing green, and it was really green. But now it's changed places, and look at it at the bottom. So that's what energy does. It can go way up or it can go way down. And usually, basically, that's oil companies. And so you've seen that because you can look at the pump and you see the gas prices have come way down, and last year they were going up very rapidly. Okay, the S&P 500. This is a chart showing it's a weekly chart, 15-month weekly chart showing the S&P 500 for the last 15 months. So you can see it goes up and down a lot. The general direction from the black arrow is, generally speaking, it's been in a downward trajectory. However, in the last 6 months or so, 5 or 6 months, you can see it's generally been trending upward. But it still goes up and down a lot. And so the intermediate term view is down and the shorter term view is positive. Inside the S&P 500, not only are there sectors, but there are growth stocks in those 500 stocks. There are growth stocks and there are value stocks. The growth stocks are, companies like Google, Apple, Facebook, Microsoft, etc. And value stocks are more companies like, Boeing, Ford Motor Company, Pfizer, etc. I call them old economy and new economy. When we put the growth stocks as a numerator, value stocks as denominator, and develop a ratio, this chart is a ratio. It plots the ratio between those two. When it goes down, it favors value. When it goes up, it favors growth. So for the last 15 months, generally speaking, it's been in a downward trajectory. But since the end of the year, last year, or beginning of the year this year, 2023, I put a black arrow to show the upward trajectory for the past few months of growth. Growth is starting to outperform value, and that was not the case during most of 2022. This is a 24-month chart of the small cap index, the Russell 2000. The ETF is IWM, and that is compared to, on a relative strength basis, the S&P 500, so represented by SPY. So you can see over the past 24 months, so it goes beyond a year, it's 24 months, when it dropped, that favored or favors large cap, the S&P 500. When it goes up, that favors small cap. So you can see in the generally speaking over that period of time, it has gone down, which has favored large cap relative to small cap. When you look at the last 2 or 3 weeks, I'm not sure if it's 2 or 3, you can see, I showed the black arrow, the small cap is really, on the short-term basis, really out of favor with large cap. And so that's an interesting chart to see that the direction so dramatic with small cap at this time. And of course, cutting through all the data is the 20-period moving average. This is a 17-month chart of the long-term government bond TLT, not a relative chart, an absolute chart. And generally speaking, over this 17-month period of time, you can see that the long-term government bond has come down. Why? Because interest rates have been going up and bond yields track that, and they've been going up. So that means the prices of bonds, this is a long-term government bond, but if you applied it to the short-term or intermediate term government bond, they would be similar. They would just move at a different amount, but the trajectory would be the same. I put a black arrow at the bottom to show that there is starting to be, in the past several months, strength in the long-term government bond. This means that if the bonds are going up in price, slightly up in price, it means that yields are starting to come down, or interest rates and yields both starting to come down. The dollar continues to show weakness. It went up for many months, and beginning about October has begun a trajectory down. So the intermediate term view is dollar is weakening. And gold has been on a run for the last 4 or 5 months, and I'd say 5 months, and you can see what it has done. I represented that by the black arrow. going up. Uh, so this is a 12-month view. So you got gold going down for a period, which we saw a lot of last year, and then going up for a period. And then when I do silver, silver's a little different. It showed more weakness toward in the early part of the year, but is now showing a lot of strength. So you can see that the general trajectory is upward, but is not as consistent in its upward direction as gold is. But the moves up in silver have been more dramatic than gold, and I'll show that in the next chart. This is a relative strength chart. You're showing whether that goes up or down, which one is moving, how is one moving relative to the other. So if this goes down, that would favor gold, because the numerator is silver, denominator gold. So if it goes up, that's going to favor silver. So you can see from December till a couple of weeks ago, it definitely favored gold. Gold was showing more strength or more consistency, and silver was declining. In the last couple of weeks, silver has been outperforming gold quite a bit, which has been resulted in the tick up at the end, showing relative strength favoring silver. Bitcoin has been in a long-term downward trend up until about the end of the year of last year, and then now it is moving up, is moved up quite a bit, but because it fell so far, it doesn't look like it's gone up a lot, but it actually has gone up quite a bit since about the first of the year. Volatility index. As risk was entering the market, up until a week ago, the volatility index was starting to rise. And now, because this last week was more positive than negative, the volatility index has dropped quite a bit from greater than 25 down to 2174. So that's a pretty big drop. So it says that there's volatility, at least for right now, in the short run, has started to be reduced in the market. Asbury Research last week, I think the last couple of weeks, was all negative. All 6 metrics were negative, and as of this past week, 2 of them have now moved into positive. So the overall view is still negative from Asbury's perspective, but 2 out of 6 are positive. The cross-asset relative performance, taking certain assets or components of the market relative to others. Again, this would be a relative strength basis, looking at the ETFs, which are in the second column. The ETFs have one versus the other. So we're seeing a lot of very definite strength in some areas compared to some definite weakness in other areas. For example, let's just take the green boxes. The green boxes going from left to right would be the last week, the last month, and the last quarter. So all of this is a relatively short-term view. Bonds are doing better than stocks. Low volatility stocks are doing better than high volatility stocks. Large cap is doing better than small cap. We saw that in previous data by quite a bit. The broad market is doing better than the blue chips, represented by the Dow Industrials. And technology is doing better than the broad market. That's represented by the NASDAQ 100 compared to the S&P 500. Growth stocks are doing better than value stocks. U.S. is doing better than developed markets. And then we go over into the bond area, and corporate bonds are doing better than high yield bonds. So high quality, better than lower quality. And the long-term bonds are doing better than the short-term bonds. Again, a lot of these have flipped, doing very different than they did last year. So in a market that is a better market, at least it is for right now, this would be more what a normal market or a slightly positive market would look like. The U.S. versus the world. The U.S. still, this has gone on for a long time, the U.S. still is not strong enough relative to all of these countries to get a green box. Sometimes it's slightly better, but not enough to show a trend. So the only two that are showing a trend are Japan and Taiwan, and they are better than the U.S. in all three views, both the weekly, monthly, and quarterly. When I took Taiwan, just to show you this view, it was a little easier to work with than Japan, so I showed you this view. So from late October, so this is about 5 months, you can see the trajectory of, on a relative strength basis, EWT is the ETF for Taiwan compared to SPY for the US. So when you compare those two over the last 12 months, this is what it looks like. And particularly for the last 5 months, you can see how well Taiwan has done relative to the US. Gold and silver. So you saw on the gold chart that it was kind of flat for the week. It has gone up nicely and then stabilized. Silver continued to go up this past week with a gain of 3.1%. Gold was negative by 0.5% compared to the previous week. So this is comparing Friday prices on March 24th to the previous Friday prices on March 18th. The gold-silver ratio, which a lot of people track, is the value, the price of gold relative to the price of silver is what is the gold-silver ratio, and that's 85 to 1 as of this past Friday. That's down from a couple of weeks ago where it was 91 to 1. I say that anything that is greater than 40 to 1 favors silver, and 85 to 1 definitely favors silver as a better value. So now I thought I'd report the cost of a monster box of silver is $13,005. That's 500 rounds of generic silver, not a silver eagle, not a silver maple leaf, but a generic stamp. It's still pure silver, but that's defined as 0.999% silver. And it looks like it's pure silver, but there's a minuscule amount of filler in there. And the markup, and that includes the markup. So that's the spot price plus $2.70 for the markup, the premium. And then times 500 is $13,005. Of the markup, the retailer gets some portion of that, not all of it. I think he says, depending on how they buy it now, it's $1 to $1.30. Maybe it's closer to $1 per ounce as far as what the retailer actually gets. So this information came to me from my son Preston, and he's a retailer, and I'm passing it on to you because you can, I'm a fan of buying local and a fan of buying from brick and mortar, not over the internet, from somebody you've never met. So it gives you some pricing information so that if you want to buy a monster box, that's what the price is. That breaks down to, I believe it's $26.01 per ounce, including the markup. So thank you for watching. If you have questions or comments, leave them in the comment section below, and I will try to answer them. Thank you.